If you own property in Australia right now, you must be cheering because prices keep going higher and there's no real end in sight. In this video, I want to discuss with you what could potentially cause the end of the housing boom and when I suspect this could actually happen. Now, of course, none of this is financial advice. I'm some guy on YouTube, but you may want to stick around because I'm going to share with you what I think is the most pivotal part and the biggest thing that could potentially cause the housing boom to actually end. If you're interested, keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I bring out videos here weekly regarding real estate, cryptocurrency, and financial freedom. Now in this video, what I want to discuss with you is one thing that I'm not really seeing many people talk about, and there's not many articles out there that also talk about this. And it's really about what could cause the Australian housing boom to actually end. Now, this is something that I think about a lot because obviously I'm a buyer's agent and I basically research property, look at property every single day and talk to a bunch of agents. Now, talking to clients, people are getting scared, right? And that seems to be the general trend here is not just clients, people I'm doing strategy sessions with, but also in the comment section below, I'm hearing a lot of fear. And that's mainly due to the fact that we've got lockdowns. Now, will the lockdowns actually cause the housing boom to end? No, I don't think so. And I started seeing some articles come up today as well, where they started talking about, and these are economists, right? So they should know what they're talking about. They're coming out and saying, well, the housing boom could potentially end in 2022 to 2023, purely because of the Delta variant. I don't seem to agree with that. And what I found was very interesting and what I think could potentially cause it to end, but I don't think it's happening for a few more years. Now, you can take what you want from it. Of course, none of this is financial advice, but let's just deep dive into, I guess, a hypothesis I really have, and you can make up your own mind at the end of this video. The Reserve Bank and fellow watchdog APRA are preparing to arm themselves should lending standards deteriorate, with its governor saying he couldn't rule it out within the next year. The Reserve Bank has previously indicated that it has been monitoring both the housing and mortgage markets, working with APRA to collect data on the banks and talking directly to the financial institutions. So this is interesting. We've had conversations around where RBA's come out and said, look, the housing problem is not our concern. We are just looking at inflation. And as long as the inflation isn't hitting our band, we are going to keep either keeping rates at record lows or we will continue to cut them even further. So that's where a lot of these Australian banks came out and said, okay, well, if that's the case, that the RBA doesn't want to move their rates for a couple of years, that could eventually mean that we won't have to push on any rates for a few more years, which means we can continue growing our loan book. What we see here is the introduction of APRA. Now, these guys are the Australian Prudential Service, right? And these are the guys that really caused a mid-cycle slowdown when it came to 2018, 2019. This is what, really caused people to think, okay, maybe this Australian property stuff's not all it's cracked up to be. It can't continue to keep going up forever. I've got a video here on this channel where I discuss why I think it could potentially go up forever, and you should definitely go check that one out. But in this, we are seeing that there's chatter between the RBA and APRA. Let's just see what this actually results to. RBA Governor Philip Lowe reaffirmed the stance when declaring the August rate decision last week, stating it is important that lending standards are maintained. But speaking to the House of Representatives Standing Committee on Economics on Friday, Dr. Lowe stated he is yet to see any signs of deterioration in lending standards. We're not in a situation where we were in last decade, where almost half the loans in the country were being made without $1 principal having to be repaid on a regular basis. These were the interest-only loans, and you'll recall last decade there have been very dramatic boosting in lending standards for investors, Dr. Lowe said. Now, what happened was we had them come in because, people were just taking out loans like crazy. And we would have found ourselves in another situation where the GFC really would have affected here with people taking out loans, brokers were just giving loans to anybody, and there wasn't really that much of a due diligence process attached. And I remember now looking back, when I started investing as well 7 years ago, the conversations I was having with a bank and a broker were very different to what I would be having right now. That's not purely because I've got, a larger portfolio now. It was because they were looking at different things. Now the paperwork that you need to put through is just enormous compared to what we had to do back then. So I think the point that they're trying to make is the RBA is like, hey man, things are pretty cool here as long as you guys don't deteriorate loan standards. And that we haven't really seen. So if we haven't really seen that, the RBA doesn't want to get involved because they've said interest rates, our problem only for inflation, not housing prices. APRA doesn't really have to make a move because they're saying, well, everything's above water, right? Everything's all good. Everything's above line, right? There's no concerns here, and lending standards have actually increased, if anything, over the last couple of years. So we're not seeing that, and we're not seeing the interest-only loans, and we're not seeing underwriting standards weaken. The RBA has signaled that it would take action alongside APRA if it deemed lending growth too strong with a high rate of debt-to-income ratios. So I've been having a lot more conversations over these strategy sessions where people are saying, well, real estate's great, but Ravi, you seem to be investing elsewhere as well. Why would you do that? And what are your thoughts on that? The reason being is debt to income ratios. We need to pay attention to this because this is what I think will be what causes this housing boom to really come to a standstill. Again, how many people are talking about this? Not many. But what we need to keep in the back of our minds is the reality of lending standards and conditions remaining how they are now for the foreseeable future is not really a smart way to approach this. The way that I look at it is if I can get a loan today, I'm probably going to go get a loan today. But if I can't, and I'm waiting for planning out ahead in the next couple of years what I'm planning to do with property and investing, I've really got to pay attention to the fact that I can't have all my eggs into one basket being real estate. And I know that's
weird because I'm a buyer's agent. Why would I tell you not to buy real estate?
So if we aren't looking at real estate, what else are we looking at? Now, you've seen obviously on the channel, there's a lot more videos about crypto. You may hate those videos because I know those videos don't get as many views as the real estate ones. That's because you aren't interested right now. I'm saying just spend some time learning that sort of space and it's only going to help yourselves. I know that over the next couple of years, when lending restrictions do come in, because they will, that's when people are going to go, oh, wow, like I can't buy real estate anymore. I can't get to financial freedom just purely on real estate numbers. Now I need to look at alternative investments. Well, you're better off trying to learn and educate yourself now over the next couple of years, get really familiar with these things so that when you cross that bridge, when you cross that bridge,
not if you cross it,
when you cross that bridge and the housing boom does slow down and we've got these lending criteria change, you will be able to adapt. All I've been saying for the last 18 months in this channel, adapt or die. You need to really be ahead of the curve, otherwise you're going to get left behind. Now, we'll go through a little bit more about what APRA and RBA are talking about because I think it's very important. While Dr. Lowe was reluctant to set benchmarks for intervention, he commented it would be necessary if credit growth picked up materially from where it is currently. Let's say we're talking about double-digit credit growth sustained for a period of time, income growth was running at 4 to 5%, that would be problematic in my view. At some point, APRA would be considering interventions. At meetings of the Council of Financial Regulators, APRA and the RBA have considered tools such as raising the minimum interest rate the banks use for home loans, which would squeeze out how much they could lend to individuals. Dr. Lowe mentioned potential portfolio loan-to-value restrictions or debt-to-income restrictions. We're not at the point that those restrictions are needed, but I can't rule them out of point emerging within the next year. Time will tell. This is very interesting because the reality of owning 30, 40 properties was, achievable 5, 10, 15, 20 years ago. Now we're having conversations where you're like, I'm going to struggle to get to like 7 or 8 properties because that's just how the system's been created. Now, unless your income is substantially high and exponentially moving up, you're going to get to a point where there's a ceiling of how much you can borrow. I've got videos on this channel. You definitely go check it out as to how you can increase your borrowing capacity and how to scale up. There might be a few things there that you haven't really looked at the moment and you can still take advantage of. But what I'm saying to people right now is, guys, this is coming. Now, it's not there to scare you and it's not there to prompt you to go, well, I better go and buy property ASAP, anything I see on realestate.com. No, I'm not saying that. What I'm saying is have a plan, have a strategy. Understand that these things are coming. And if your broker, your buyer's agent, your conveyancer, whoever's in your team isn't talking about these things, you need to find someone new. At the end of the day, I'm planning out how I can prepare for the next 5 years. And when we start seeing conversations like this around credit growth and lending criterias and income to debt ratios, well, think about it. If you really want to retire just on the basis of having a scalable portfolio of like 8 or 9 properties and that's all you're going to ever learn, that's all you're ever going to do, well, what happens when they say debt to income ratios need to change now and you can now only get 3 properties? Are you now going to go and sit there and be like, oh no, this was crap, like I can't believe this happened to me, and victimize yourself? Or are you going to adapt? That's what I'm saying. If you have time now, spend that time to get educated, adapt your thinking, break out of those traditional ways of thinking, like, I only buy one property now and then I'll buy one in like 10 years time. If the opportunity is there, you may as well buy when you can, because I know for a fact, I don't have any regrets for pushing a little bit harder earlier. And now I know that these conversations are happening. I'm going to push a little bit harder next year and the year after that before I really think it doesn't make sense to get into property when prices are taking off parabolically. And in line with the 18-year cycle, I believe the top of this market will be anywhere from like 2025 to 2027, 2028. The thing is, I don't want to buy anywhere close to that, because the potential for a restriction to come in, a lending criteria to be changed, that could be the cause of what we see as a 15, 20, or 30% drop in the Australian housing market. Now, before you jump in and say, well, that's not really possible because you said it wasn't possible, Ravi. Well, it's not really possible and doesn't really make sense when the market's really been flat and moving down for about 10 or 15% already to then drop by another 30%. But if the market's moving up and it goes up by 15 or 20% a year, and then it does it the same the year after and the same the year after, well, then I'm getting a bit, concerned, because the market becomes a bit frothy. When it becomes frothy, everything works in cycles and we need a correction. I think that correction's coming in a few more years, later than most people think, but I also think it's very, very smart to start adapting, understand what other things are at play, and having conversations like this are very healthy. If you guys are interested in, having a strategy session, there's a link in the description below. Definitely go check it out. And if you're new here, definitely subscribe, because I bring out videos every single week and you get to see my lovely face talking about finance. I'll catch you guys in the next video. Thanks, guys.